Good morning and welcome to the RM2 webinar on an introduction to employee ownership trusts. My name is Richie Cowley. I am a director of RM2. Just please note that if for any reason you need to drop out of this webinar, it is being recorded and it will be posted to our YouTube channel. So look up RM2 Partnership and it should be there in a day or so. Also, at the end of the webinar, we are going to do a bit of a whirlwind introduction to employee ownership trusts. So at the end of the webinar, you'll receive contact details if you want to get more resources regards to employee ownership trusts and want to contact us with any particular questions. So thank you very much for joining us this morning. Really appreciate you taking the time. This is just going to be a very quick introduction to employee ownership trusts as an alternative way of selling a business to the traditional models. So we just thought we'd start off with the kind of objectives that our clients have told us when they're considering an employee ownership trust transaction. And then we're going to look at the alternative, the sort of traditional forms of selling a business, and whereas EOT tends to meet these objectives, sometimes the alternatives don't particularly. So fairly important, owners like to achieve a fair value for the businesses that they have built up. The EOT route probably doesn't give you a maximum value, which can be created if you have a competitive market for your business, but it gives you a fair value based on the profitability and assets within the company. It keeps the business, so another one of the objectives that owners have is that it keeps the business intact. And certainly for an EOT transaction, the business after the transaction should be pretty much the same business as it was before the transaction. And then linked to that, keeping the business intact, it leaves a legacy that a founder can sort of look back on with an element of pride. Now the thing about, because the business after the transaction from an EOT is pretty much the same business, it has the same management team, and as a result, the selling shareholders can exit at a timescale which suits them, which may be immediately or may be not for the foreseeable future. Third-party transactions, obviously the date of exit may be dictated by part of the terms that the purchaser is agreeing. Another big objective is to avoid contingent deferred consideration. Find that we're told that when you have contingent deferred consideration, which is based on sort of performance measures, it sometimes compromises the directors who stay within the business, who need to start working in a way that doesn't quite fit in the way that they previously worked in with. They like to minimize risk and conflict during the transaction process. And so that you have a third-party transactions, you have a risk that somebody might walk away, and actually, you know, by their nature, third-party transactions can be confrontational to the extent that both parties are trying to get the price for a business which suits them. A very important part of setting up an EOT, and one of the key objective which shareholders, owners tell us, is that they like to look after and to a certain extent protect the employees who have helped them to build the business up to what it's arrived at. And also it's to suitably reward the successors post after the founder owner managers have moved on from the business. So what we have is the traditional forms of sales. So you have the trade sale, which are happen fairly often, or basically your general third-party sale. Private equity sale, which if conditions are right, private equities may be interested in purchasing an owner's business. Certainly not very common, especially with the size of the businesses that tend to do employee ownership trust is an IPO. It suggests that you have a certain amount of scale. Liquidation, unfortunately, this is kind of a real route for exit of owners, i.e. if they can't find a third party to buy the business, sometimes they are actually forced to liquidate the business and therefore take assets out of the business during the liquidation process. And then management buyouts, which is probably the most similar to EOT transactions. However, the big difference is that during a management buyout, the ownership will go to a fairly small number of employees, plus those employees actually have to be the ones which are investing in the business, whereas that is not necessary with an employee ownership trust transaction. So just giving a little bit of background, so the employee ownership trust, it is a form of employee benefit trust, which have got a bit of a shady past due to certain abuses which have happened in the last sort of 10 years, where they were used in tax avoidance schemes. So Rangers is up there because it's probably one of the more famous of the less savoury transactions, where Rangers players and some staff were paid via EBTs without any tax being paid. So although employee ownership trust is a specialist version of an EBT, an employee benefit trust, it is very different from those kind of transactions. We've actually put up the Finance Act 2014 because that is basically the legislation which created the model for EOT, and there's a certain amount of rules and hurdles that need to be got over in order for it to be recognised as any transaction as an employee ownership trust transaction. And John Lewis is there because effectively it was a stated ambition in part of the legislation to create a model which was similar to the John Lewis. So effectively create a John Lewis economy. These transactions are the number of transactions that are gathering momentum. So to date, I think the number of transactions is done over 300. We're expecting it to get to around about 350 by the end of the year. But the momentum is actually gaining in speed, I would say. So there's more and more businesses which are looking at this as a genuine alternative to the traditional ways of doing transactions. So these are the more famous of businesses which have now completed EOT transactions. So you have at the top the makers of Wallace and Gromit, Aardman Animations. Richard Sowers was an interesting one because that's the first time I think that it really caught the attention of media with Mr. Richer we think not just selling his business at a significant discount, but then passing a lot of the consideration, or 20% of the consideration, to his staff. And the bottom one is AHMM, which is a large firm of architects. And architects have particularly embraced the model of EOTs. I think to date, it's 15 out of the top largest architecture firms within the UK has now converted to the EOT model. We think that actually companies which traditionally were partnerships, actually the EOT model works very well with those type of businesses, because by definition a partnership business is kind of owned by its employees, with new employees coming up. The difference is it's becoming more difficult for partnerships to encourage new partners to pay in equity or go into debt in order to pay their equity stake, and EOT gets you to kind of the same situation without employees having to invest in their own businesses. So just going down to, now we're getting into the nitty-gritty of what is a EOT transaction. So effectively, your shareholders sell to a controlling interest in their business to a trust, to the employee ownership trust. The trust is set up and it will be for the benefit of all employees. That's important. We'll go into a little bit more detail about all employees. And to encourage a wider ownership or company ownership by employees, the government has set up some fairly generous tax incentives for owners to participate in these transactions, and that is that an EOT transaction is exempt from capital gains tax, and therefore there is nothing to pay in terms of capital gains. And once a business has been owned, has been purchased by a trust, and it becomes an employee ownership trust business, it gives employees the opportunity to enjoy bonuses which are tax-free. That is not to say that they will be national insurance free, so there is still employees and employers' national insurance to pay for that, but the limit is up to 3,600 per year, which will give an extra sort of 750 odd pounds in employees' pockets. So it's quite a notable benefit. As I mentioned before, the legislation has set up a number of hurdles or criteria which has to be met. And we're now going to go into these. We'll do each in turns. So the EOT must operate for the benefit of all employees and on the same terms. So what does that mean for all employees? It means basically everybody. Everybody who's employed by a company which is owned by an EOT must become a beneficiary of the trust. This happens automatically. There are no documents passed to employees. There are no share certificates given out. If you are an employee, you are by definition a beneficiary of an EOT trust. The only exemptions that there would possibly be is you could have a qualifying period. So a new entrant into the business, you may say that they need to work for the business for 1 year before they can become a beneficiary. Excuse me. The maximum you can do is 1 year. Obviously, you can do any point, 6 months, or even not have a qualifying period at all. But also, any current and former employees who had more than a 5% stake in the business will not be a beneficiary of the trust, and that goes on into the future. So if you're an employee who used to have a 10% stake in the business, you sold that 10%, you will not be a beneficiary of the trust. Now, on the same terms, now this relates to how benefits are distributed via the trust. It also is the same rules for any bonuses which are paid under the tax-free rules. And it's around basically the distribution down to employees. So if it's coming out of the trust, this will predominantly be if a business which was EOT is then subsequently sold to a third party. So the important thing is actually an EOT business can actually be sold. So the way that you could split up the distribution is it has to be done objectively. It can't be discretionary. So you can't have a class of employee who gets more than another class of employee. And therefore, the way you can do that is you could split it all equally. That's fine. But there's also scope, as put in the legislation, to use other criteria, and the ones which they give are to do it based on level of remuneration, level of hours worked, level of and the length of service that you've put in. It's possible to have any mix of those. You can't multiply one by the other though. There are no other criteria in which a distribution can be made. And remember, that is the same criteria where you pay out bonuses, but we'll get into a little bit more detail in terms of bonuses. So the next criteria, it's fairly basic, the one at the top. So the company must be a trading company or being the holding company which owns a trading group. So the next one is about to qualify for the to become recognised as an EOT-owned company. It has to be that control has passed from the previous shareholders to the trust, but you don't have to sell 100% of the shares. So the criteria is you have to have 50% plus one of the number of shares, 50% plus one for the voting rights, 50% plus one for the rights to profits, 50% plus one for the rights to assets on winding up. Just going back to distribution of any dividends, almost without exception, I think there's one or two which may have been paid a dividend by the company that they own. By and large, employee ownership trusts waive their rights to dividends. The reason that you would pay a trust a dividend would be to distribute it down to the employees who are the beneficiaries of the trust. However, if you did it that way, you would be paying tax as the dividend goes into the trust, and then as it's distributed down to the employees, you'd be also paying tax. They would also be paying tax on what they received. As a result, it's a very inefficient way of distributing funds to employees. It would be much better to pay them their tax-free bonus via the company. It's worth mentioning that this criteria that the CGT, the capital gains tax relief, which is only available in the tax year when the EOT first acquires control. So if you're an owner of a business and you owned 100% and you decided that you wanted to sell the business in tranches, that's absolutely fine. You could still use the EOT model. However, it's only when the EOT's holding in that company goes over 50% that the relief is available. So if you sold 60% of it in 1 year and then 40% of it in the next year, the exemption to capital gains tax would not be available in the subsequent year. you would still almost, well, very likely have entrepreneurs relief available to you. However, you would not be able to do it down the exemption route. So the final criteria, it's if you look to the legislation, you get a long-winded load of formulas and what happened and what have you. Effectively, this can be described most easiest in that former owners and current owners of a business which own more than a 5% stake in the equity, you can't have more than 40% of those employees employed in the total employee body to qualify as an employee-owned business. So your 5% holding also, that would include any connected parties. And so what we're talking about there is people who are related to the previous owners or current owners, current minority interest owners, sorry. And the definition of someone who's connected is really quite wide. So you're talking about nieces, nephews, uncles, aunts, and the people who are married to those. However, we only really find that this becomes an issue when you get really quite small companies. So companies which have got less than 10 employees in total. And the reason that this rule exists is to stop very small family-owned companies taking advantage of the exemption to CGT, selling a family business into a trust, which is then also owned, and the beneficiary are also family members. There's actually a limit in terms of how the length of time that this rule needs to be met, and that also precedes the transaction date but then goes on afterwards, and that's from 12 months before the disposal date to the end of the tax year in which disposal takes place. And after that point, it does not matter. So this next slide, we kind of just done a quick sort of comparison between how EOT relief compares to entrepreneurs relief. So just going down this table, so in terms of a minimal shareholding, in order to be able to hook into entrepreneurs relief, you need to have at least a 5% stake for 2 years. It used to be until quite recently 1 year, but now it's 2 years. Whereas the EOT, it doesn't matter. So you can have a very small stake and you'll still be able to sell your shares as part of other shareholders to a trust and not pay any CGT. Just in terms of other conditions to hook into entrepreneurs relief, the selling shareholder needs to be an employee or officer of the company. That again is not a constraint for EOT. But as you can see, we're just making the point again about relief only being available for when the control takes place for the EOT transaction. So for the tax relief, entrepreneurs relief is your 10% CGT still needs to be paid, and there is a lifetime limit of 10 million. Whereas for an EOT transaction, there is basically they're exempt from corporate capital gains tax, and there is no limit. However, conditions post-sale for entrepreneurs relief, once the transaction has taken place, there are no sort of conditions which have to be met for the selling shareholders. Whereas with an EOT, effectively, if the criteria which need to be met for the EOT are not met within the tax year or the following tax year in which the transaction takes place, basically the CGT which you've avoided then crystallizes, and that will come back to this selling shareholder. Actually, the same thing happens if the business is subsequently sold after that period, so after the tax year following the transaction date. However, the liability for the tax will go back to the actual trust. And it's just one of the criteria that if a business was EOT owned and was thinking about being sold to a third party, it's just they need to be aware that there could be a tax liability which would be crystallized, and so that would need to be put into their calculations about whether they want to sell the business to a third party. So obviously, if you're selling a business to a body, to a trust, and you're selling it for a price, somehow that transaction has to be funded, and which is not completely obvious when you have a trust which has been set up specifically for the reason of buying a company, because that trust will have no funds and it has no access to any income on its own account. It is entirely, so effectively these transactions are paid for one way or another by the cash which is generated from the company, the trading company that has been acquired. And therefore, in terms of actually paying shareholders for the shares which have been sold to the trust, there are a number of routes. The first and most obvious is you actually take free cash from the trading company's balance sheet. So surprising number of our clients have an element of a cash, sometimes a little bit overstated to call it a mountain, but have free cash sitting on their balance sheet, which is above and beyond what's needed for working capital. This is quite important because actually it gives another benefit for doing the EOT transaction. So one, you'll be able to use that cash in order to actually pass it over to the trust to pay for the transaction. But actually that cash, when you're valuing the business, arriving at your fair value, generally speaking, the valuation will be done on the level of the profitability of the company. So EBITDA, which is very close to, is used. So that's earnings before interest, tax, and amortization, but it's kind of like operating profit. So you take a multiple of that, which is for EOT transactions, is probably going to be, well, 3 would be low, 5 would be getting towards the high side. That gives you an enterprise value, and then you add any free cash to that valuation and then take off any debt, and that would give you your equity value. So effectively you have free cash on your balance sheet, it's going to increase the value of the business, and then that cash can be distributed as part of the capital transaction to the selling shareholders, i.e. you can distribute cash from a trading company without any CGT or income tax, which would be extremely advantageous, as the alternative route would be potentially to pay it out as dividends, which obviously will be subject to income tax. So generally speaking, because of the way that businesses are valued, unless you're selling your business at a fairly significant discount, that won't cover, free cash will never cover the total purchase value. And therefore, what generally happens in the majority of cases that we deal with, the shares are sold to the trust does an IOU back to the shareholder. In other words, a vendor loan is created. In the vast majority of cases, that will be an interest-bearing vendor loan, and there will be repayment terms attached to that loan. So we have a third-party loan is also on this list. we are finding an increasing number of banks and other financial companies willing to lend on the basis of an EOT transaction. We kind of say that it is possible to do this, or well, I say relatively easy. It's possible to do these kind of these loans if you have an EBITDA of £1 million and above. If you go below £1 million EBITDA, the number of banks which would be willing to lend reduces significantly, plus the actual costs of setting up the loan rather becomes restrictive, because you have a commitment fee, you'd have to pay for due diligence, and you'd have to pay for their legal fees. And if you're only sort of borrowing, say, less than £1 million, if you're having to pay £50,000 in costs to the bank before you even get the loan, it becomes a less compelling route. And also, obviously, the thing about vendor loans is that, generally speaking, selling shareholders tend to be fairly flexible in terms of enforcing repayments, because they understand the sort of general cycles that businesses go through. So if the business is going through a bit of a hard patch and a little bit short of cash, vendors may well agree to actually suspend a repayment or an interest payment for that period. Whereas that's far more difficult to negotiate with a bank, and there's likely to be consequences if you do that. We put private equity investment at the bottom. This is quite rare. It's possible in terms of a private equity organization taking an equity stake. It has happened, but the trouble with private equity type businesses, they're always looking for a controlling share, which obviously they can't do. You get private equity type financiers who concentrate on giving debt, but they kind of sort of sit in your third party loan. Obviously, the cost of these things increases as you go down. So your vendor loan, I mean, they should be putting a market rate of interest on it, but you know, we've known vendors who have actually waived their rights to interest. In fact, those that have set up the loan agreements without any interest in them at all. Third party, if you're looking at a bank, you're probably going to be talking about 4% to 6% interest payments. Private equity type financiers, you're going to be up, we suspect, sort of 7% up to 10%, maybe even higher, if they think that it's a particularly risky transaction. So now we're going to go through basically a quick sort of breakdown of how these transactions take place. So you start off with a EOT being created, and effectively that's done by a trust being created, by a trust deed, and the company recognizing that the trust exists. So a trust is established. The shareholders then will go through a process that they will agree a fair value and payment terms with the trustees and the company. Generally speaking, the fair value will be decided of by a valuation by a third party, and the rules are that the trust must not pay more than a fair value. So any valuation which is done is the maximum that the sale price can be arrived at. However, there's plenty of examples of shareholders who sell their businesses at a discount just because they don't want to burden the business going on with too much debt. Plus, they want to get they want it all done and dusted and paid back a little bit quicker than they would do if they got the full fair value. So, of course, the shares are then transferred over to the EOT. So the shares are bought by the EOT, and as we described, there may be an initial payment, if there is spare cash in the business, or if you take out a third-party loan, there would be funds coming straight into the EOT to be paid to the shareholders. So this is how the shareholders, so the loans, which were the vendor loans, which will be sitting in the trust. So what happens is the company will effectively gift cash over to the trust, which will then pass that will distribute that down to the shareholders. It's worth noting that the funds which are passed from the company to the trust are post-tax. They are not a taxable expense. This is a capital transaction, and therefore they are not put against your tax computations. The typical sort of time period in which you would expect these the full loans to be paid off, if it's sold at full fair value, is between sort of 5 and 7 years, but that's quite dependent on the performance of the company. So if the company does better than was anticipated, these things can be paid off quicker. If the company has a downturn, obviously the shareholders potentially are going to have to be a little bit more patient to receive their funds. So this is something which can be done in order to protect the shareholders' interests, and this is taking into account that actually there is as we mentioned, there's a fair amount of time over which the selling shareholders are going to be paid. And therefore, to slightly protect them, a charge can be placed on the company. There's actually generally a guarantee from the company that they will pay the EOT the funds needed to service any debt which is sitting in there. And this is a proper charge. A debenture is created, and there's a charge put onto company's house. This is not something which absolutely needs to be done, but it kind of does protect the shareholders to a certain extent. The charge cannot be put against the equity of the company, because the rules is that you can't have any kind of contingency situation which could then have the equity going back to the selling shareholders. So what you have is a charge over the company assets. So once the transaction is done, the employees are eligible to receive tax-free bonuses. And we'll sort of go through that in a little bit more detail. It's worth just highlighting there that as per normal with bonuses, it would be the company which would be paying the employees, not the EOT. So this is not a distribution via the EOT. And the thing about an EOT transaction is that you can sell 100%, or the EOT can hold 100% of the equity of the business, but it actually only needs to own 50% plus 1, as mentioned earlier. And therefore, we have plenty of examples in the clients that we have. In fact, I would say the majority of clients that we have helped do these transactions will have minority interests, which predominantly are going to be employees of the company. And this all goes back to sort of objective of the selling shareholders or owners of the business wanting to make sure that their successors are going to be suitably rewarded. So not only if they keep their any shareholding or share options below the 5% threshold, then not only can they sort of benefit from dividends and any sort of capital growth in the equity that they're holding, but actually if the business is sold subsequently, they also would get a chance to be a beneficiary of to get a distribution from the trust, because they would still be beneficiaries of the trust. But that's only if you keep the shareholding less than 5%. We think there's an awful lot of 4.9% shareholders of EOT-owned companies out there. So you could, I mean, generally the way this is done, you know, you could have shareholders selling or giving shares directly to employees, but generally this is done via a dilution of the shareholding from EOT. We'll get into a little bit more detail in the next slide or so. So this is going back to just a little bit more detail in terms of the tax-free bonuses that employees can receive. So the maximum amount which can be paid out, and this is per year and every year for forever, is 3,600. These balances are due to be reviewed at some point. In fact, it's supposed to be reviewed in 2019, but obviously the government is rather distracted at the moment, so that has not happened. So that yearly limit could increase. I guess at some point is likely to increase. Just a remind again that national insurance still needs to be paid on on any bonuses which are paid by EOT. Just going back to reiterate, the bonus needs to be paid to all employees and has to be done on the same terms, and the same terms is as per we discussed before. So basically, if you've got a bonus pot which is going to be paid through the EOT rules, it has to be distributed to all employees equally, or based on remuneration, or based on hours worked, or on length of service, or a mix of any of those criteria. If you pay a bonus 1 year, it does not fix the calculation for that bonus. You could change it from 1 year to another. It's worth mentioning that the rules about participation do not apply for bonuses, so it really is all employees. So if you have an owner who sold his shares, in fact sold just a controlling interest, still could retain some shares, they are still entitled to a tax-free bonus, and this is because the tax-free bonus is paid by the company, not by the trust, and therefore employees do not need to be a beneficiary of the trust. And then this is just a little bit more about basically your opportunities or flexibility in terms of minority interest for employees. So they can be done where you want to incentivize the next generation of directors. So you can allow them to subscribe for new shares. You could allow them to do some kind of tax efficient EMI option scheme, and that would allow them to have less than a 5% shareholding, still be a beneficiary of the trust, but be entitled to entrepreneur relief when they actually sell the shares. Generally speaking, you would set up the whole concept of bad leaver, good leaver if you're setting up these kind of schemes, because you don't really want leavers to go away from the company and take their shares with them, because that starts giving you a bit of an administration headache. Plus, you wouldn't want to allow a employee to take some shares, then sell those shares, and then use those funds to set up a business in competition to you. The thing about the EOT transaction, and because basically, generally speaking, there is loans sitting in the trust, if you did a valuation of a company post-transaction, you would actually come out at a very low value, basically because a valuer would take into account that the company is obliged to pay the loans which are sitting in the trust, and therefore you have a sale price which is matched by the loans, and therefore, you know, for all intents and purposes, the company would be valued at a very low value. Now, this gives you an opportunity to allow employees to purchase shares or even gift shares at a very low value, or with no benefit in kind liability for the tax. And as I said, the majority of our clients take advantage of that to motivate and incentivize the next generation of directors and senior managers. And that can be done up, in theory, up to sort of 49%, minority interest up to 49%. Most don't go quite as far as that. So I'm just moved it forward a little bit and fast. So we're now sort of getting towards the end of the webinar. So we're just going to run over a quick sort of summary of what we see as the benefits for an EOT transaction. So very important, but actually probably often not the most important reason that owners do these transactions is that they can get a fair value for the value of the business that they're selling. They can also exit on terms and at a pace that suits them, so they can have time to sort of bed in the next generation. To be perfectly honest, some vendors stay in the business in order to make sure that actually the vendor loans are paid off and the business continues to be run successfully until that point. Mustn't forget, there's full CGT relief on any consideration which is received by the selling shareholders. Oops. These transactions, generally speaking, are controlled by the company and by the selling shareholders. It's not like a third-party transaction. As a result, the only chance you're going to get of a potential buyer, i.e. the trust, walking away from the transaction at the 11th hour is if the shareholder changes their mind. It's not like a third-party deal. If you decide you're going to do this and you are able to do an employee ownership trust, it will happen unless you change your mind. But the whole sort of thing about minimum disruption is also very important, because these are friendly transactions. There's not really a need to do due diligence. The buyer doesn't need to do due diligence. You don't have to open your books to potentially all your competitors and giving away all your sort of margin secrets and such like. These transactions are generally done very quickly, whereas if you're trying to sell to a third party, your negotiations can go over a very prolonged period of time. And we just mentioned that one previously. Very important, it is the same company post-transaction as it was before that. So the company remains independent. It can have the same structure. It can have the same directors. So you can have as much time as you like to do your succession plans. And as a result, the same company continues going forward. The founders have their enduring legacy. We haven't mentioned this before, but it's pretty important. You have the opportunity, if you're doing an EOT transaction, to get advanced clearance from HMRC. And effectively what that is doing, that HMRC are agreeing that the structure of the transaction that you're embarking on, it does qualify as a EOT transaction, and therefore any distributions and consideration paid for that transaction, including your free cash, is going to be seen as a capital distribution and not an income distribution. And that can be done before the transaction takes place. So employees become beneficiaries of the business in a very sustainable and long-term way. So just basically these, although there's been sort of 350 transactions in the UK, it's been done for sort of the last 5 years. That's not a huge amount of transactions. However, the same sort of model is been working and is far more established and has been around for a lot longer in the US. And studies have been done on employee-owned businesses in the US. And generally speaking, they are seen as having more motivated staff, more efficient staff, and interestingly, more robust to downturns within their market. So yes, it's not a guarantee that your business is going to be successful, but it does give an opportunity that the employee body can feel more ownership within the company and actually benefit more from the company into the future. So we're coming pretty much to the end of the webinar. I hope that has been a suitable taster for you. As I mentioned before, if you want to go into more detail, we have a publication which is very sensibly called An Introduction to Employee Ownership Trusts. It's about an 80 page book, but it gives a whole load of detail in terms of how the transaction works and how they can be structured, and what kind of options and flexibilities you can have with that. If you were going to consider these transactions, it is a very useful book to be a reference book into the future, because it's quite difficult to hold all the sort of different details in your head. And we're very happy to give, if you want a copy away free. Just need to email me. Email address is shown, and we'll put one in the post to you pretty shortly. Also, if you want to chat, the phone number, the office phone number is there. I'm not sure if I mentioned at the start, I am prepared to take questions, but maybe because I didn't mention it before, there are no questions there. I apologize for that. But as I say, please feel free to get in touch. I hope this has been useful. Yeah. Oh, we've got a question popped up. So we get into a sort of, yes. So the question is, can all trustees be elected by the workers? That's an interesting question. We haven't really discussed how the trust is controlled. The trust is controlled by trustees. Generally speaking, you'll have sort of 3 or 5 trustees. You'll have an odd number because you don't want to have deadlock in terms of decision making. The legislation is completely silent about who should be trustees, and as a result, you can pretty much have anybody you want as a trustee of the business. And the answer to the question is, you could have all the trustees elected by the workers. That is generally not what happens. So if you had 3 trustees, the general makeup in our experience would be that one of the trustees would be a vendor, one would be from the new management team who wasn't a shareholder, and then another trustee, and that might be another member of the management team. It might be a trusted advisor, so an independent trustee, or it might be an elected worker, and we have had some examples of that, and some who have entered into quite a sort of a process in order to elect that trustee, those trustees. So yes, the simple answer is yes, you could have 100% elected trustees if that's what suited your business. So we've had no other questions. As I said, please get in touch if you have any questions, and I think we're pretty much done. So thank you very much for listening. Please get in touch, and please ask for the book. Thank you.